Missouri just declared gold and silver legal tender. But the IRS still sees your silver stack as a taxable collectible. That one contradiction has created one of the biggest legal conflicts in the precious metals world today. States like Missouri, Utah, Oklahoma, Arkansas, and Louisiana are moving toward constitutional money by recognizing gold and silver as legal currency and removing state-level taxes on bullion transactions. But the federal government hasn't changed its position at all. According to the IRS, your silver is still classified as a collectible, meaning profits can be taxed at rates as high as 28%. So here's the problem. You could walk into a business in Missouri, pay with silver, and the state may treat that transaction as legal tender with no state capital gains tax involved. But the IRS still expects you to report that exact payment as a taxable event on your federal return. The state says silver is money. The IRS says it's property. And precious metals holders are trapped between two completely different legal systems. For retirees and long-term silver holders, this isn't just a technical issue. It directly affects taxes, reporting requirements, and even everyday transactions. What sounds like tax-free constitutional money at the state level can still trigger federal reporting obligations, audits, penalties, and collectible taxes. Here's where most people get confused. Some believe state legal tender laws automatically eliminate all taxes on gold and silver. Others think the laws are meaningless because federal law overrides everything. Both assumptions miss the real picture. State laws absolutely matter. They can remove state sales taxes, eliminate state capital gains taxes, and legally protect the use of gold and silver in commerce inside those states. But they do not erase federal tax obligations. That distinction is critical. Understanding exactly where state authority ends and where federal enforcement begins is the only way to use these laws without accidentally creating IRS problems. In this breakdown, we'll cover what Missouri's sound money legislation actually changes, which taxes disappear at the state level, why federal collectible taxes still remain, how the IRS treats digital gold and silver payment systems, why every debit card swipe backed by silver could become a taxable event, which states currently offer the strongest sound money protections, and the constitutional conflict sitting underneath the entire debate. This is educational content only, not legal or tax advice. The information is based on Missouri Senate Bill 194, IRS Code Section 408M, constitutional provisions, and current federal tax policy as of 2026. Now let's separate state sovereignty from federal supremacy. The most dangerous misunderstanding precious metals holders make is assuming state tax law and federal tax law are the same thing. They are not. Missouri can eliminate state taxes on silver transactions. Missouri can recognize gold and silver as legal tender. Missouri can treat constitutional money as currency instead of property. But Missouri cannot override federal tax law. Under the Supremacy Clause of the United States Constitution, federal law overrides conflicting state law in areas where the federal government has authority, and taxation is one of those areas. That means you can legally benefit from state exemptions while still owing taxes federally on the exact same transaction. If you sell silver in Missouri for a profit, Missouri may charge zero state capital gains tax. But the IRS can still apply federal collectible taxes up to 28%. State legal tender laws protect you at the state level. They do not shield you from federal enforcement. And confusing those two systems is where people cross from legal tax planning into potential tax evasion. So what exactly changed in Missouri? Missouri's sound money legislation officially recognizes gold and silver specie coins minted by governments as legal tender within the state. The idea comes directly from Article 1, Section 10 of the Constitution, which states that no state shall make anything except gold and silver coin legal tender for debts. But businesses are not forced to accept silver. The law simply allows two parties to voluntarily transact using precious metals if they both agree. The bigger change is taxation. Missouri removed state capital gains taxes on gold and silver transactions. So if someone buys silver, holds it for years, then sells it for a profit, Missouri no longer treats that gain as taxable income at the state level. From the state's perspective, you're exchanging one form of money for another, not selling an investment asset. That's a major shift, but the IRS completely disagrees. Under Internal Revenue Code Section 408M, physical gold and silver are classified as collectibles. Not currency, not legal tender, collectibles. And that classification triggers a completely different tax structure. If you hold silver longer than 1 year and sell at a profit, the IRS can tax the gain at up to 28%, much higher than standard long-term capital gains rates for many traditional investments. The federal government's position is simple. State legal tender laws do not change federal tax classification. You can call silver money at the state level all you want. Federal tax law still treats it as property. That means every profitable silver sale still requires federal reporting. You still have to document gains. You still file Form 8949 and Schedule D. And you still pay the collectible tax rate when applicable. Now things get even more complicated with digital gold and silver systems. Missouri's framework also opens the door for gold and silver-backed payment infrastructure. The idea sounds simple. You hold physical silver in secure storage. A debit card links to that metal balance. When you buy groceries or coffee, a tiny amount of silver gets sold behind the scenes to complete the payment. In theory, you're spending constitutional money in everyday commerce. But the IRS sees something very different. According to federal tax logic, every swipe becomes a separate taxable transaction. If silver increased in value between the time you acquired it and the moment you spent it, the IRS may consider that a taxable capital gain, even if you were only buying a cup of coffee. Think about what that means. Use a silver-backed card 200 times in a year, and technically you could create 200 separate taxable events. Each one may require acquisition date, sale date, cost basis, proceeds, gain calculation. That creates a massive record-keeping nightmare for ordinary retail use. So while digital precious metals payments may work legally at the state level, federal tax compliance makes them extremely difficult in practice. Missouri also isn't alone in this movement. As of 2026, states now fall into two main categories. The first group includes states like Missouri, Utah, Oklahoma, Arkansas, and Louisiana. These states recognize gold and silver as legal tender, remove state sales taxes on bullion, and eliminate state capital gains taxes on precious metals. That creates the strongest state-level environment for sound money advocates. The second category includes most other states, over 40 of them. These states often remove sales tax on bullion purchases, but still apply state capital gains taxes when metals are sold for profit. So the level of protection varies widely depending on where you live. But regardless of state policy, federal taxes still apply nationwide. That's the key point many investors miss. The constitutional conflict behind all this is fascinating. Supporters of sound money laws argue that gold and silver are already recognized in the Constitution as lawful tender, so taxing their exchange is unconstitutional. Their argument is simple. If exchanging dollars isn't taxed, why should exchanging constitutional money be taxed? The federal government responds differently. Washington argues Congress has broad taxation authority and that, under modern monetary law, precious metals are investment assets, not official circulating currency. And as of 2026, federal courts have not ruled that state sound money laws override IRS authority. So the IRS continues enforcing collectible taxes in all 50 states. That means state legal tender laws are real and valuable, but limited. They reduce state taxes. They legalize commerce using precious metals. They support sound money infrastructure. But they do not currently provide immunity from federal taxation. Here are the two biggest myths causing problems for precious metals holders today. Myth number 1. If silver is legal tender in my state, I don't owe federal taxes. False. State exemptions do not erase IRS obligations. Myth number 2. The IRS can't enforce collectible taxes in sound money states. Also false. Until federal courts say otherwise, the IRS still has full authority nationwide. So what's the safest approach if you live in a sound money state like Missouri or Utah? Take advantage of state tax savings. Buy bullion without state sales tax. Sell without state capital gains tax. Use legal protections for private commerce. But at the same time, keep detailed records. Track cost basis carefully. Report gains federally. Stay fully compliant with IRS rules. And if you plan to use gold or silver-backed debit systems, speak with a tax professional who understands precious metals reporting requirements before using them regularly. Because the real winners in sound money states are not the people who assume taxes disappeared. They're the people who understand both systems, state and federal, and operate legally within both. Missouri's sound money law is a major development in the growing push toward constitutional money. But the IRS hasn't changed its position. Silver may be legal tender in your state. Yet federally, it's still treated like a collectible investment asset. And until federal law changes, precious metals holders have to navigate both realities at the same time. Know your state laws, respect federal law, and keep your silver legal.